Hey guys, welcome back to the Market Interest. The market has been super volatile lately, except the energy sector has been outperforming by a lot. Take a peek at this bloodbath, really. The S&P 500 really has just been getting, beat up a lot. As we all know, we've all seen it in our portfolios. Except when we look at the energy sector. The energy sector has been doing phenomenal. If we take a look at the sector performance, year to date, Brent oil is up 58%, which is wild. And then commodities, they're up about 38% as well. When the rest of the market, the overall market, we're down 13, 14, 15%. So if you've been focused in on energy, then you've really been having a really nice year so far. A lot of people, they've been seeing the great performance and they're just unsure if it's too late for them to get into the market or if they should just still hang on to their tech stocks, their growth stocks, and wait for the rebound to come and try and buy in. And I'd say there are really some very, very attractive opportunities within the energy sector. And I want to share two companies that I think are really, really good companies with a lot of potential. I had an incredible opportunity to speak to both of the CEOs of each of these companies at Louisiana Energy Conference. And it was really a great experience. And they share a lot more about their companies and the opportunities that they see ahead. So I'll share those as well. Let's dive right in with the first company, National Energy Services Reunited. NESR is one of the largest national oil field service providers in the MENA and Asia Pacific regions, and was one of the first national companies from the MENA region to be listed on the NASDAQ, with over 5,000 employees representing more than 60 nationalities and 16 countries. So NESR is one of those companies that I would consider a higher risk, high reward, and the CEO says so himself. The company is located within the Middle East and North African region. So they're within 16 different countries within the Middle East area. So the dynamics, the way that they run their company is going to be different than a company within the US. Also, the cost of doing production is a lot cheaper in that area. Speaking with the CEO, as I'll show you guys shortly, he mentions that the cost of a barrel of oil could be $2, $3, $4 per barrel. And the margins on that, when right now they're selling at over $100 a barrel, there's huge profit margins on that. So for a company to be located in this type of area, have lower costs, obviously there's going to be some type of geopolitical risk associated with it and a currency conversion risk as well. But at the same time, this is the type of company where I believe it has some longer term appreciation to it, not just a short term investment. So let's dive into this. Let's go over some of the conversation I had with the CEO and learn a little bit more about the company. Here, can you give us just an idea, breakdown of what your business model is?
So we are basically a public company in the Middle East. We are the only, I would say, oil field services in the Middle East publicly listed on NASDAQ. And our business is basically the upstream servicing the exploration and development of the oil field of the national oil company, mainly the Saudi Aramco, the ADNOC, the PDO, the Oxy, working mainly in the Middle East and North Africa. And again, publicly listed on NASDAQ. And usually people, if they want to invest or go to that market, there is nothing public that is only in that field.
Interesting. And you said you were in 16 countries. With there being, I guess, so many political tensions right now in certain markets, are you finding that there is a consistent theme within different countries, whether it's ESG, or are you finding that other countries are being more open to producing energy and having that energy production continue?
So look, I mean, we are in the field or in the business and the countries where the GDP and the majority of the income comes from oil and gas. Mm-hmm. So those countries are really dependent on oil and gas exploration and selling for their income to spend on their healthcare or education, employment, etc. So it is not really just for a business, it's for actually survival, for the country to exist, right? And that is obviously the Middle East, the majority of it with the GCC countries, some of the Algeria, Iraq, Libya, all the wealth comes from oil and gas. Mm-hmm. And that's why our business is very consistent. Even in the downturn, they don't drop, because again, that is the main revenue stream for the country. Sure. In addition, the cost per barrel is very low. And that's what people usually in North America miss, that it is not a $30, $40 per barrel. The cost per barrel can be $2 to $3. in some of those fields. But in average, let's say it's a $10. So the service industry portion of it is maybe $2 to $3. And that's why the business has to continue, because that's the income of the countries.
So the past year, your stock price was, I guess, lagging the overall industry, but obviously month to date, or so far this past month, your stock is up 30%. So where was like the disconnect, or what has the company been doing differently to now have investors see so much more of the value in your company?
I think part of it is obviously the valuation metric. When you are the only one that is purely a Middle East player on the NASDAQ, people do not know what to compare you with. So because of the size, they small you with the small medium cap and they compare you to North America. So you go down with them despite the fact that your business never actually dropped. If you look at my revenue is only up year on year, every year. And so then the people that understand the international market, they will compare you to the international service company, which is like Schlumberger, Halliburton, Baker, and then they give you a discount based on your liquidity. Yep. That's usually how it works. And I think there was a bit of a miscommunication or misunderstanding of that. And when the market went up, a lot of people just obviously dive into the North America. Now they see that the North American went back to the right level, and people are looking for an opportunity to buy some stock at a lower, did not appreciate. And I think that's when they looked at us, we are still depressed, your market did not pick up, so now they are looking at the stock.
Yeah, and clearly people have seen that. I mean, 30% in the past month, that's blowing away most of other companies, especially when you look at the S&P 500. It's down 15% still year to date. So, so clearly
we are still very cheap compared to the comparative of the international market. So, international market usually trades 10, 11 times, and we're still trading 4.
4, exactly.
So that's why people see, there is still a long way to go on the stock.
Yeah. Do you have any concerns with energy prices fluctuating? I guess in the valuation of your company, if we do start to see energy prices decrease, then do you have any concerns over the next, I guess, 6 months, 12 months, 18 months?
No.
In terms of
I would say not at all. And people have been in the industry for long enough. I saw 3 to 4 downturns and upturn myself. I can tell you this is exactly 2005 upcycle.
Okay.
So this is a 3 to 5 years minimum cycle, which means because of the underinvestment of 7 years of the energy worldwide, there are no fields that can potentially replace the demand that is coming. Even in case of a recession, you're still gonna have a strong oil price. It might not be 110, it might go to 80, but that's very profitable.
Yeah.
That's extremely profitable. So obviously you have the geopolitical notch here that is 115, 120 because of Russia, but that is, without that, you still are into this $1 to $2 million, 1 to 2 million barrel per day balance, which is extremely risky. So you have one country going down, you have a refinery having a problem, you will have an oil price jumping to 150. So, but there is no fields that are waiting to be produced. And that's what people need to understand. And that's why a lot of people say, but the oil, no, the oil is going to be needed for a long time until the transition happens. So you can be very bullish to say this is at least 2030, or you can be even conservative, which we say 3 to 5 years. So that at least you have a very solid cycle for at least 3 years.
Okay. So as you can see, NESR is, again, one of those companies where it has higher risk but really high reward opportunities to it. Full disclosure, I'm long this position. It's a company I really do believe in, and I think they've got some really unique propositions to their company. Again, not looking for huge returns within a short period of time, even though within the last month, I mean, they're up over 30%. That's no guarantee. I do feel like they have some longer term appreciation and opportunities to it. Let's jump on to our next company. Number 2 is VAALCO Energy. VAALCO Energy is an independent energy company principally engaged in the acquisition, development, and production of crude oil. VAALCO's strategy is to increase reserves and production through the development and exploration of international oil and natural gas properties. So VAALCO is another smaller cap energy company, and they have been having a phenomenal year. They were up almost 150% in a 1 year period of time, which is really phenomenal performance. Now, again, it's in the energy field, so it's going to be volatile. I would expect some volatility just in the sector altogether, and probably a little bit more volatility than other stocks just because it's a smaller cap company. But they have some really strong plans for their company over the next year, 2 years, 5 years. And speaking with the CEO and their CFO, we got a little bit more insight in terms of what their plans are, where the opportunities are for this company, instead of just looking at some short-term growth. And while we all appreciate the capital appreciation they've had over this past year, they also have a good dividend policy that they've been putting in place and been reducing the amount of leverage they have on their books as well. So some good opportunities, setting a solid foundation for the future. Let's dive into that interview right now. Your stock price is up 170% year to date, which is incredible. Over a 1 year period, over 185%. You guys are clearly doing something right. So I'd love to learn a little bit more about the business, share with our investors what you guys are doing, because clearly other investors are intrigued with your company. So can you guys just start off by giving us a sense of your business model?
Well, the business is relatively simple. We're a small cap E&P company. We're focused in Africa. Our main producing asset is offshore Gabon, and we have another asset offshore Equatorial Guinea. And as an oil and gas company, especially a small oil and gas company, we really can only focus on two key components of the business: cost and production. We don't control pricing, we don't control the commodities. So we have to focus on how efficiently can we produce that oil and how can we keep that production maintained. And we have an excellent asset in Etame. We've been producing in that asset and that same sand for 20 years now. From 2002, this is our 20th year of production. And these efficiencies don't come free. We have to invest to create those efficiencies, and that's what we've been doing in the last 12 months, investing in production efficiencies to reduce cost, investing in drilling activities to enhance both reserves and production. And the combination of those events, coupled with what we've seen in the increasing commodity prices, have really taken off in the marketplace for us.
It seems like everybody, a lot of companies' free cash flow is increasing this past year, obviously. What are your plans with any additional free cash flow at this time? Is it really just increasing efficiencies within the company, it sounds like, or dividends, policies, buybacks?
I think there's a couple of things there, Brian. I mean, this year we've gone into probably a record capex spend. I mean, the drilling program that we embarked on beginning of December is ongoing at this point in time, and we've also got our FSO changing this year. We're investing over $150 million of our capital this year, and that's primarily being obviously funded by operating cash flows, which is great. But we announced our maiden dividend in Q4 2021, started paying it in Q1 2022. It was a 13 cents annual dividend paid quarterly, and at the time was about 4% yield. Our share price has done extremely well, and clearly, and that yield is under 2% now, and we understand that. I think our doctrine would certainly be, and as a board, we haven't ruled out other capital returns, especially with the commodity prices the way they are. But first and foremost, our position was get the drilling program funded, get the FSO position funded, get it on time to budget, and that's what we're doing.
Okay, excellent. Are you guys looking at any type of acquisitions at all? Has that been top conversation?
I mean, I think any E&P company of our size clearly has growth aspirations, and there's a number of reasons for that. We talk some about ESG and energy transition. For our company to embark upon energy transition, we have to be a certain size, so we have to have that growth aspiration to have that longevity. So there's a couple of things we've been looking at. One is having a deep dive inside their existing asset base, and rather than the whole narrative being about what we're doing in the next 12, 18 months, start telling the investor what we're planning to do in 2025, 2027, and how we in building an exploitation of our existing portfolio, how we add to that portfolio, and how we begin that transition that needs to happen. We talked some of that with our recent ESG publication that came out this week. But clearly, any producing company right now in the E&P space is getting a lot of inbounds. And one of the key things that we're trying to marry up, and I'll be very clear here, we're not buying assets at $120 oil, because that's just not how we view things. So we're screening at a much lower price, because we've got to make sure we're getting in a position that provides that value point forward for our investors. Secondly, we're looking at the opportunities where there's a strategic fit. So strategically, do we want to enter into this area where strategically another participant is looking to exit? Because if there's someone just looking to exit for value, then that will be, one, a very procrastinated negotiation, because our value and their value will differ by some degree. So the strategic position of potentially an IOC or potentially an NOC looking to exit a jurisdiction is really the kind of opportunities we're looking to seek.
All right, there you have it, guys. Two good interviews with two great companies. Again, these are both smaller cap companies within the energy sector. So just expect there to be some volatility. These, again, investing is for the long term, but make sure you talk to a financial professional. Feel free to click the link in the description down below if you want to set up a one-on-one consultation and see if these stocks are appropriate for you and your portfolio. But you should expect some volatility. There's some levels of risk there, obviously. But really, in terms of the way that they're running their business and their operations and potential for growth, I'm intrigued by it. I'm long both of these companies, and I think it's a good position for other people who could sustain some of that volatility and risk within the company. Again, the energy sector is something that I believe is going to be a strong performing sector probably for a few years. At this conference, they had some really fantastic speakers talk about the supply and demand factors associated with this sector. And just to be honest, there's a huge demand for energy right now, huge demand. And especially with Russia, Ukraine, and I guess the rest of Europe right now, having complications in terms of how they're going to be getting their energy. It's going to be a difficult time for people in the world to get that energy. And it sounds like a lot of these companies are really producing to the max. They're doing as much as they can right now. It's just they can't produce enough energy to sustain the demand. So I've seen some other studies and heard a speaker actually out in Europe who was saying that they believe that the peak for oil in 2030, so 8 years from now, that's where they're starting to see the demand actually peak. So it's kind of incredible to think about just the dynamics in terms of how this has happened. But I think there's a lot of factors that are being built within this. Now, there's no guarantees that that the energy sector is going to be doing extremely well for the next 3 years or 5 years. But I believe that it will be a prolonged time where they're profitable. A lot of companies are paying dividends. And within a rising interest rate environment, that's usually the type of companies you want to be invested within, are the ones that are profitable and paying you a dividend. So again, I'm overweight the sector. I believe that it is a profitable area to be within for some time. But again, make sure that you're talking with your financial advisor or have a conversation here. We can have a one-on-one conversation and see if these are appropriate for you, these stocks are appropriate for you, or if there's some other stocks within the sector that are appropriate for you, or if there's some ways to just rebalance your portfolio and have it make sense for your financial position. So that's what I got for today, guys. I appreciate your time. Don't forget to like, share, and subscribe to the channel, and I will catch you all next week. Take care.